There are clear links between infrastructure development and trade growth, the massive economic multiplier. Goods trade relies on roads, ports, and other physical infrastructure. Yet, there is a $6 trillion gap between infrastructure needs and available financing. This gap is predicted to widen to up to $15 trillion by 2040. Investment in this space is particularly important for less developed markets. Raising the capacity of countries with below-average infrastructure even halfway to the global average could increase global trade by $377 billion. Likewise, digital infrastructure is critical to drive trade growth. A 10% increase in internet access correlates to a 1.38% increase in GDP in developing countries. A 10% increase in mobile phone penetration can drive trade by 1%. Emerging markets have the greatest need for infrastructure spending. Asia alone requires over 50% of the projected global infrastructure investment gap. The Americas face an investment gap of 32%. Africa currently faces a gap of 28%, though this is forecast to widen to 43%. The reluctance to invest remains high due to investment risk and regulatory environments, and is projected to continue during the 2020s. Trade finance, a catalyst for expanding global trade, faces a similar dilemma. As much as 90% of global trade is reliant on trade and supply chain finance, and is estimated to be worth around $10 trillion a year. But there is a $1.5 trillion gap in financing in the sector. This gap is predicted to widen to $2.5 trillion by 2025. 60% of trade finance requests by SMEs are rejected, compared to only 7% of requests by multinational companies. Access to trade finance is one of the top 3 export obstacles for half of the world's countries. In Africa alone, trade finance requests see rejection rates of over 50%. Technology has a major role to play in improving access to trade finance. For example, fintech and blockchain can help bridge the divide for SMEs with the provision of alternative trade finance solutions, otherwise unavailable. New players will emerge to compete with banks and provide trade finance to sectors typically overlooked. If embraced, technology could save banks up to $500 million each year alone in KYC costs, and it's estimated that the full digitalization of trade finance processes would streamline over 90% of data field interactions. Despite the critical role trade finance and infrastructure play in economic growth and in boosting trade, large investment gaps continue to plague the sectors. Given the increasing gap set to grow in the next 10 years, increasing the size of the trade finance pool, leveraging technology, increasing the success rate of applications, and driving stronger global standards will be critical in the years ahead. To find out more and hear our recommendations how to grow trade in the decade ahead, download the report at futureoftrade.com.